All data points towards an upcoming recession. The big question is, does it make sense to get some risk off? Does it make sense to sell some stock, to sell some Bitcoin? Let's have a look at the connection between recessions and price developments. So here is one very convincing argument. When we look at the credit card spending momentum index, that's very, very low. Only during the COVID crash, we have seen lower levels. People aren't spending that much in a discretionary fashion anymore in the US. When we look at the personal savings rate, that's also very, very low at 3.4%. We saw a massive spike after the COVID handouts, but usually the levels that we observe are around 5 to 6%, not around 3%. Here's another convincing indicator. This is the unemployment rate, and this goes very nicely in waves. We saw a massive spike again during COVID, and this tends to creep up again. And because of all of that data, people are now expecting that the Federal Reserve is going to lower interest rates. The main target of the Fed, though, is to keep inflation rate low. Officially, the inflation rate is at 3%, but if we measure this a bit more precisely, as here on the Truflation Index, we are actually only at 1.5% already. Now, why would we care about inflation rates? Why would we care about interest rates? Because it does have an impact on the monetary base, right? As there's more and more money printing going on, prices of assets should rise. Now, let's compare interest rates and inflation rates over time and how much impact this actually had on stock prices. Check out this graph. In green, we've got the officially measured inflation rate. So that's currently at 3%, not just at 1.5%. And in purple, we see the interest rate. So that's currently higher. That's at 5.5%. So it does cost money to borrow now. Whenever the inflation rate is above the interest rate, you actually get paid to borrow because your debt devalues faster than what you have to pay for that debt. Now, there are two vertical lines here, and those lines indicate a time window. Between October of 2080 to May of 2001, the interest rates tended to be higher than the inflation rates, so it was expensive to borrow money. In other words, one would expect that stock prices should be going down during such a period. Now here we have stock prices with those same vertical lines. This is the S&P 500 divided by the money supply, divided by USM2. So during a period where we should actually expect stock prices to go down, we've seen them outperforming monetary expansion. And that outperformance was roughly a 3x. So stock prices rose much quicker than monetary expansion, despite interest rates being very high, despite money being very expensive. And so I personally do not believe that interest rates and inflation rates have that much of an impact on stock prices, because companies can adjust their prices and companies can be somewhat hedged against inflation. I believe the main impact of interest rates is actually on the bond market. If you're also expecting interest rates to come down, I personally do expect this in the next years. If you're expecting this, then I believe that this will mainly benefit government bonds, long-term government bonds. Check out this chart. At the top in green, we've got SPTL. This is a long-term government bond ETF. And at the bottom, we've got the interest rates, right? The target interest rate set by the Fed. When interest rates tend to go down, long-term government bonds tend to go up in price. When interest rates tend to be low and not rise, long-term government bonds tend to do okay. Once interest rates do rise though, then there isn't that much to be gained. Then we tend to rather go down. When then interest rates fall again, we see the exact inverse. Long-term government bonds go up. And when the Fed gets hawkish and raises interest rates, that's when long-term government bonds crash. In other words, if we now believe that the interest rate is going to come down, we should expect long-term government bonds to go up again. And there is actually some logic to this. The price of a bond is determined by the present value of all of its future cash flows, of all of the future payments. If those payments are further out in the future and interest rates are very high, you have to discount those future cash flows a lot. If interest rates are low, you have to discount them less. In other words, when interest rates go down, then you have to discount those future cash flows less, thus the present value goes up. There's a direct inverse link between interest rates and bond prices, long-term government bond prices. So when interest rates go down, long-term government bond prices go up. And again, I believe this effect is very strong with bonds. It's very, very weak with stocks. Because what we see over here is again a long-term government bond ETF. And what we see at the bottom is the correlation coefficient of those long-term government bond prices to the stock market, to the S&P 500. Sometimes there's positive correlation, sometimes there's negative correlation. This is simply just randomly wobbling around zero. So the things that affect stock prices do not affect bond prices. They do not move in sync. So when you've got a portfolio of stocks and of bonds and of Bitcoin, etc., you can balance out different risk factors. I believe that the speculation around interest rates and around inflation rates is pretty much irrelevant for stock prices. It is only relevant for bond prices. Are we going to see the recession? Probably yes. Are we going to see falling stock prices because of this? Probably no. We might see declining interest rates, but that will simply just support the long-term government bond prices. If you learned something out of this, feel free to give this a like. It helps the channel grow. Feel free to also subscribe. I publish videos regularly. In case you've got Telegram and in case you're interested in crypto, then there's a dedicated channel for you to join. It's 100% free. Feel free to click on the link down below. Looking very much forward to chatting with you. Cheers.